All right, let's quickly take a look at the week ahead. Quite a busy one that we've got coming up, so let's jump straight into it, starting with today. Now, today we get some regional updates for Eurozone inflation, the Spanish HICP flash. We get the German statewide CPI as well, and obviously the fully updated German data a little bit later. Then early, I believe tomorrow morning, we get the French data, and then obviously after that, later tomorrow, we get the Eurozone flash HICP or inflation data as well. Now, in terms of inflation data, could this be tradable? Look, I think the only way that any type of Eurozone data will be, attractively tradable in a week like this will be if we see massive upside surprises. Why do I say that? Well, if you take a look at what is priced in for markets on the rate side, the ECB is already expected to be the most aggressive cutter this cycle, right? The markets are expecting them to cut first. They're expecting them to cut the deepest. And to be fair to the market, growth has been horrendous for the better part of the last 14 months. So that does make sense. But we always have to, when you look at things like this, you always have to ask yourself how much of what is expected is already priced in. Now, if you take a look at positioning information for the euro, let's just go up here to the euro. I would say there's a fair bit of negativity already priced into the euro at this stage. I don't think at this stage that more negative data will be that much of a surprise for the markets. If inflation shows a downside surprise this week, the markets will be like, yeah, okay, fine. We already expect this bank to cut first. We already expect them to cut the deepest. It would need to be a massive deflationary print to see the markets pricing in even more aggressive cutting for the bank. And maybe that could be tradable. But even then, I just think so much bad news is priced in for the euro. I would be very reluctant on trying to chase downside in the euro in a week like this if we get downside surprises in the inflation data. So I think the best way that we could potentially look to trade something like this, again, I would probably want to wait for the dollar data to play out before trading something like the euro. But if we do see massive upside surprises in the inflation data today, maybe that could give us an opportunity to, get long some small risk on euro dollar upside. That could be a possible way to play it. The other one that we could reluctantly look at is some maybe euro sterling upside. We had a massive reversal in that move we got in, that we saw, a couple of sessions ago. We're basically back to the 0 point. So back inside that dangerous range we've been stuck in for the past few months as well. So that is something worth considering. But maybe some short-term euro upside could be attractive if we get a big enough upside surprise. But if we just get a downside surprise in these, I just don't see how that changes anything for market expectations right now. I think a ton of that is already priced in. I think a ton of that is already expected. So I would prefer upside surprises as the only thing that's really attractive to trade the euro with. Massive upside surprises could be good to trade. If we don't get that, then I don't see I just don't see a reason to trade it apart from that. We also get some growth data tomorrow, which again, for the same reason, could be interesting. We get some flash GDP data coming out for Germany, and obviously the total Eurozone composite number. Now, just on the Eurozone composite number, remember that by the time we get this data, the markets will already have a very good idea of where inflation for the Eurozone will land. Why? Because we get most of the regional prints before that, right? We get the Spanish data coming up today. We get the German data today. We get the French data, and I believe the Italian data coming up tomorrow. After we've gotten all of that, the markets have a very good idea of where that Eurozone total number will land. So just keep that in the back of your mind whenever you trade Eurozone inflation. We normally see the bigger move happening before the actual event because the markets have a very good idea of where these things will land by the time we get it. Same story with the flash PMI data, right? Something we always talk about in a lot of detail. So Eurozone data could be interesting if it's massive upside surprises, in the GDP and the inflation. I think that'll be the most attractive way to trade it. If we don't get that, then I just don't think it's going to be that interesting to trade it on the short side, not with what's priced in. I don't think that gives us a real good edge to work with. Now, apart from that, tomorrow morning, nice and early, we get a fresh batch of Chinese data, the NBS PMIs, as well as the Caixin manufacturing PMI. And I believe we get the services. Let me just see. We get services. Can't see the services. Maybe only coming up next week on the services side for Caixin. But these ones, always important for China, always important for growth. What are we looking for? Just like the euro, if we get a downside surprise in these data points, I just don't see how that is attractive to trade for the markets right now. So much bad news has been priced into China over the course of the last few months. It's old news, right? If the data surprise is lower, that's old news for the markets at this stage. So just like the euro, I believe the only thing that's attractive to trade on the Chinese data would be massive upside surprises. If we get these numbers all punching above the priors by quite a bit, moving into the 53s and 54 regions, I think that could be really good. That could give the markets that last bit of conviction that they need to really start chasing the China move. I mean, pay attention to Chinese equities, because we had the Hang Seng up close to 8% last week. Take a look at this week-to-date numbers on the Hang Seng. Hang Seng up 8%. Month-to-date up 6%. These moves, they are moving pretty aggressively. So I think there could be some opportunities there. We have the three boxes, right? The first box was checked, where we had supportive monetary policy coming in. Well, actually first on the fiscal side, then the monetary policy side. Now the only thing we need the data, the actual data, to come out and show us that, yes, that recovery that everybody's been hoping for, it's actually starting to happen. And I think that'll give the markets conviction to trade these things on the long side. So we are currently holding position in this. If we do get a massive upside surprise, though, I wouldn't think twice about adding some additional risk to that current open position we've got running for the A50, potentially maybe switching to something like the Hang Seng, just because from a momentum point of view, that has been the bigger mover. Also something worth, just considering. Now, apart from that, let's just quickly go back to the Aussie. Aussie, always something we need to watch when it comes to Chinese data as well. Very, very closely tied to the Chinese economy. Over 40% of exports goes to China. From Australia, that is. So whatever happens to China, it's going to be important. I still think the Aussie dollar at these levels are massively underpriced for the reasons that I explained last week. So maybe there could be some short-term opportunities to take advantage of with the Aussie. If we see that Chinese data coming in really good, maybe we could look for some short-term upside in the Aussie. But just keep in mind, the Aussie is going to be very susceptible to dollar flows. And the dollar has a monster day coming up the day after on Wednesday. With all of the events. So just, keep that in the back of your minds as a possible risk, but that is something worth looking at as well. So that is Tuesday. Wednesday, nice and early, we get labor data coming out for Kiwi. I'm not sure what to make of this one this week. Markets are expecting a worse number, especially on the unemployment rate, expecting it to go from 4 to 4.2. The data has been so mixed for New Zealand recently, guys. Mixed inflation, mixed growth, mixed on the labor side. Look, if we get a massive downside surprise, I would expect that to weigh on the Kiwi. Would I want to trade the Kiwi lower, though, if we get that downside surprise? I don't know. I think the only thing that could be worth trading the Kiwi against might be the Aussie. That there's a very clear differential there in play from a policy point of view. Maybe there could be some upside there. The challenge with trading this thing at these levels, something we always talk about when it comes to the Aussie Kiwi is, remember, buying this pair is a mean reverting pair. It has been, for the last 8 years now, 7 years. It's a massive mean reverting pair. So the further and further we go out that spectrum away from that 108 pivot, which has basically been the pivot where we've been oscillating around since 2022. The further we go away from that, the bigger the risk that eventually we do get some mean reversion playing out. So I think on a massive miss, Aussie Kiwi probably makes the most sense, but there is some mean reversion risk there, which we just need to be aware of. In terms of a massive upside surprise, if we do get a big upside surprise number here, what could we look to trade? It's going to be tricky versus the dollar because we have so much dollar risk going into Wednesday. Let's see how the markets trade at that time. I'm just where we sit right now. I just can't think of a good enough proxy to trade apart from Kiwi CAD. We were in this trade last week. We got flushed out at break even, frustratingly, and now we're back up again. If it's a very, very hot number, I might contemplate getting into that on the long side again. Positioning, though, still a concern for the CAD. So that is just something worth keeping in the back of our minds as well. Now, let's quickly move then to the rest of Wednesday, which is just going to be, it's going to be so busy, guys. Wednesday, apart from the Kiwi jobs data, we've got ADP coming up. Now, we're not going to be focused on ADP at all. Why? Because, quite frankly, ADP has sucked recently. You know, it hasn't given us any tradable volatility for the past few months. We know how we know it's a very bad predictor of NFP anyway, so I think that's going to be worth ignoring on Wednesday. The big events to watch, though, would be the ISM manufacturing PMI as well as the JOLTS job openings. Both of these two things can be very tradable in the short term, especially with all of the markets focused right now on growth in the US. You know, after the miss we had in the flash PMIs, after the miss we had in GDP, the markets are going to be very focused on growth, and that could make this really tradable. The challenge with trading this on Wednesday is that literally 2-3 hours after that, we get the FOMC coming up. So I would love to trade the ISM and the JOLTS. If it's a big enough deviation, I would still look to trade this. But it would need to be a monster deviation to get me off my chair and trade this going into the FOMC. And it's probably going to be a short-term trade then anyway. It's not going to be something massive. Now, just like last week, I've got absolutely no interest to trade the dollar higher if we get an upside surprise. I only want to trade it lower on a downside surprise. The reason for that, again, coming back to positioning, just massively stretched here for the dollar aggregate. At these levels, the risk reward is just not attractive to be long it. Something that could help the dollar though, running into that, is month-end flows. You know, we've got official month-end coming up tomorrow. So today and tomorrow, especially around those London fixes, it's going to be important to watch that. That could potentially push it up, but I don't have conviction to trade it on the long side. I would prefer to trade it lower if we get some real juicy downside surprises in the data. If it's upside surprises, I'm just going to ignore it. Now, what about the FOMC? FOMC is going to be interesting. Interesting, but I hope boring. I just don't think the Fed, I don't think it's in their best interest to change anything right now. Why? Because yes, inflation surprised on the hawkish side, no doubt about that. We had inflation surprising on the hawkish side, but I think that, you know, the pre-meeting commentary was already sufficiently hawkish. They already told us, listen, we're a little bit concerned about this move in inflation right now. They already told us that the markets have already appropriately, priced out a lot of the cuts that was priced in. There's only 34 basis points of cuts implied for this year. So if you think about it that way, the markets responded appropriately. The Fed is, in their commentary, managed to push back against that cut narrative. So it gives them a lot of flexibility. Apart from that, we had some pretty bad growth data coming out. Well, there's a lot of ways you can look at the growth data, but the bottom line is growth has slowed in the recent data sets that we've seen. So you've got upside in inflation on the one side, downside in growth in the other. Why not just wait? Why not just go patient, saying, guys, we are noticing the upside in inflation, but we're also noticing the downside in growth. We're just going to give ourselves some time. They can be data dependent right now, and I think that is the way that they'll want to swing it on Wednesday. So we are obviously always going to have the ultra sensitive focus on every single little thing that Fed Chair Powell says and the things that he doesn't say, and that can create some volatility. But man, it's going to be messy. It's going to be really messy because there's a lot of things he can say. If he talks about inflation, ooh, that can sound hawkish. Then he talks about growth, ooh, that can sound dovish. I think the markets are going to hear what they want to hear, and right now I'm not sure what that is. So it's FOMC. We will have a full preview available as always on the day, but I don't think that's going to be the best tradable opportunity this week, guys. I really don't. But it's something obviously we'll be paying close attention to anyway. Then on Thursday, nice and early, we get Swiss inflation data. I'm pretty upset about this one because unlike the last couple of months, we've got no analyst expectations for this print this week. I'm not sure what's going on. You know, normally we get expectations that shows us where the markets are leaning for this print. We've got none of that this week. Now, maybe it still comes in. Maybe it just needs to refresh, and that's something we'll be watching. But without having an idea what the markets are thinking, I am getting a little bit concerned about this one. You guys know that I've been bearish the Swiss franc for the last 4 months now. We've had some fantastic trades on it, but I literally closed out my last unit in the Aussie Swiss franc a little bit earlier today for CPI risk, and obviously other risk event risk we've got coming up this week as well. The other thing that's just getting me a little bit cautious about holding Swiss shorts right now is positioning. It's getting seriously stretched at these levels. You know, look at the Swiss franc. Historically, this is some really, really stretched levels. So I'm just a little bit cautious here. You know, I don't want to jump the gun with the Swiss franc. Let's wait for CPI. But the fact that it's so stretched, the fact that we don't have estimates, that makes me uneasy about holding positions into it. We can always look to trade out of it, where the way that we'll prefer to trade that is obviously on the downside, if it's another downside surprise. Then the rest of Thursday is going to be pretty boring. Yes, we get jobless claims, but is the market really going to be worried about that with NFP coming up the next day? Probably not. We've got durable goods and factory orders. Will the markets worry about that with ISM services coming up the next day? Probably not, right? So after Swiss CPI on Thursday, the main focus will shift towards NFP. What about NFP? Look, NFP is going to be super interesting this week. Now, you know, from an analyst point of view, we normally get overly excited about nothing. You know, it's just part of the package. We normally, this is the most interesting FOMC, you know, we've seen in months. You guys know how we talk. I mean, it's part of the package. But having said that, I do actually think this NFP can be very interesting. Obviously, depending on what the Fed says, that will determine the level of our excitement going into it. But the recent data that we've had is going to make this one interesting, because we had take the NFIB. We had the NFIB hiring intentions that fell, I think, to the lowest levels going back to COVID, which was quite interesting. Then on top of that, we had the flash S&P global manufacturing and services employment sub-indexes weakening as well by quite a big bit. I mean, we had the services side, which is more important because that's where the bulk of GDP is sitting for the US. That fell to its lowest since the pandemic as well. Now, the challenge with focusing on those things going into NFP is, remember, those things is soft data. NFP is hard data. The markets know and is very aware of that big divergence that we've had between soft and hard data over the course of the last few months now. So just because the soft data has been soft doesn't mean the hard data is going to be soft as well, if that makes sense. So the bottom line is that makes it very interesting, because there's a lot of players already expecting decent deceleration, but we might not get it. And, you know, even though I don't want to trade the dollar higher on good data, if NFP comes in with a whopper of a beat, I would still look to trade that short term. As a scalp, why not? You know, as a scalp, you know, you don't have to get married to the dollar on a big beat. If it's a big enough beat with everybody expecting a downside surprise, then I don't think positioning will matter in that first 10, 15, 30 minutes after the release. We can still have a really good trade if the data is a big surprise, but I would prefer a massive miss, right? I would prefer a massive miss, because that will cause the biggest upset from a positioning point of view for the markets right now, and from a Fed expectation point of view as well. So that's just a quick view for the data of the week ahead. We do have earnings as well. I will do a separate video on that a little bit later, but these are the big ones. Oh, the other one that I quickly wanted to just mention, which we also get on Wednesday, but we get the first release of that today, is the quarterly refunding announcement coming out from the US Treasury. Now, we get the estimates today, and then we get the official announcement on Wednesday. Now, what are the markets expecting from the QRA? Absolutely nothing. There's no surprises expected. The reason for that is, even though there's a few really big players on the bond side that is expecting the Treasury to have to increase borrowing at some stage, and that should then be negative for things like equities. It should be negative for things like bonds. Even though they're expecting that to happen some stage, there's so many things that should happen in between. So, for example, the markets are expecting the Fed on Wednesday to announce its date for the tapering of the balance sheet, right? Tapering off the balance sheet. So they are expecting the announcement for that to be halved on Wednesday. And if that happens, it means that Treasury has a lot less borrowing needs if the Fed decides to follow through on that. So there's a lot of gray area there, which means it's unlikely we're going to get anything from the QRA. But just like we've seen from the price action last year, going into November, if we do see a much higher than expected issuance coming out, that's going to be negative equities, negative bonds. If we see a much lower than expected issuance, like we saw back in the start of November last year, end of October last year, that'll be risk positive, equity upside, bond upside. That is something definitely worth watching. So that's something just worth keeping on the radar. We get the estimates today and we get the official announcement on Wednesday. So that's just a quick view of the week ahead. As always, any questions, don't hesitate to let me know.